Hey, ladies and gentlemen, John here with you. It's Thursday afternoon. It's a little earlier than usual. It's only about 20 till 5, and we're going to do the second update for this week. And I would have waited until tonight, but it just so happens that we have to travel this evening from here in West Virginia, where we live, to Louisville, Kentucky, which is about 300 miles, and so it's going to be quite a drive. We're not going to go all the way. We're going to go at least part of the way tonight. We have the big snowstorm coming into the area tomorrow, and my little girl Maggie has a cheer competition. She's into the competitive cheerleading. I've told you all about that a few times, if I'm not mistaken. But she's into the competitive cheerleading, and this weekend's competition is in Louisville. So for some reason, the coaches, the group, decided not to cancel, although some other squads have pulled out. They decided to go ahead with it. So just so we can, be reasonably assured that we'll make it, we're going to go ahead and go this evening and drive part of the way rather than trying to go 300 miles in 12 inches of snow tomorrow. So I'm doing the update a little earlier, and as soon as we finish up here, we'll be pulling out and hitting the road. So there's actually not a ton of information I have to share with you here this evening. I just want to review these two trades that we are currently dealing with, and just remember as we go through all the information here, please keep the disclaimer in mind. Everything that we do here is practice trading only, and although we'll look at these indexes we like to trade and the strategies I like to trade, does not mean that I'm telling you to trade those. Please keep in mind that you should not be following this service here, the Market Insights. It's any kind of like advisory service or recommendation service or alert as to what you should or shouldn't be doing in the market. So please keep that in mind. All trading involves a risk of loss. This is always the situation. So remember that also, even if we're trying to limit risk. And I don't have any trade restrictions on myself, so I could be in any or all of these trades that we're trading here in the practice scenarios. All right. So please keep all that in mind as we go through this. Hold on, just a.
What about the DVD players? We don't have the headphones installed.
Finish this up. Okay, folks, sorry about that. Connor just came in and came up and started peppering me with questions. So I did not. There he goes. But anyway, I forgot where I left off. But let's go ahead and jump right into this. Here is the current trade that we have on for February 5th expiration. So this is not that far away. The days are flying by. We have tomorrow and the weekend, and then after that, the following Monday will be the 25th. So just 2 more weeks of this trade. Now, I tell you what, I was debating how to handle this as I did this update here this afternoon, and I didn't know what to share and what not to share with you. But I'll just go ahead and tell you, I have on this position. All right, and it's okay to tell you that now. It's way too late for anyone to jump in and try to copy exactly what I'm doing. So I think it's okay to share that. But I actually have this position just as you see it right here. Now I have on a different contract amount, not a 2x6. I have more than that, but it's still the same ratio, same debit. This here, same debit. Everything's identical. Now something I did yesterday. And I think it's very easy to see why. But something I did yesterday when the market was way, way down here. I don't remember the exact price, but it was way down, like 60 points down. I actually came in here and I rolled my risk down from 1800, 1780 down, and I rolled it down from those levels from 1800, 1780 down to 1760, 1740. Okay, from 1800, 1780 down to 1760, 1740. Now, this 20-point wide spread, I basically shut it down. So I bought to close the 1800. I sold to close the 1780, and then I just rolled it down. So and I'll show you where I rolled it to. So you can see here, I sold to open the 1760, and in this example, it would be all 6 contracts. All 6 contracts. All right. And I bought to open the 1740, so I rolled it down 20 points just like that. All right. Now, so this 1800 1780 spread isn't there, but now I have a 1760 1740, and I rolled the whole lot down. So here it would be all 6. Now no, I'm not exaggerating this. I paid $1.80, by the way, to do that. $1.80 debit on times the number of contracts. If I had on 6, it would be times 6. If I had on 12, it would be times 12, and so on. So it was $1.80 debit I paid to do that. So it wasn't. That's really not that expensive to roll those down. So I rolled my risk down 40 points. Look at that. It's actually a 40-point roll down from 1800 to 1760. So I rolled that risk down 40 points and only cost $1.80. So that's a pretty darn good trade-off. So and it wasn't, and I'm not exaggerating this. It probably wasn't 20 minutes after that, and all the buying pressure came in, and we saw, the market really start to pull up, and then it still ended up closing down 22 points. But it's funny these days. Even though it closed down 22 points, you're like, whoa, we didn't move too much today. We hardly went anywhere. That's kind of what it feels like if we go down 20 points or up 20 points. It's almost like a sigh of relief. You feel like we didn't really do anything out of the ordinary. But the market closed down 22 points, and it was just kind of like a non-event. But either way, it was a move that was made. So what we're going to do here is we're not going to add this in. Now, if you want to add it in and follow it along on your own practice platform or on paper, that's totally fine. But we're not going to add it in here. But what we have now is today's day, where the market did come up a little bit, and again, volatile day. It traded all the way up to 1890, and then had a low here. It was down 10, 12 points at one time, and then we finished up almost 10. All right, so is this predictable? Can you really analyze this and make sense out of it? Not in my opinion. You can't. Not in my opinion, because things are just so haywire right now. It's not what we call a healthy market, where it just trends one way nice and slowly and has healthy pullbacks and keeps going, up or down either way. It's just not that environment. But that's something I wanted to show you there, because that was a move that I felt necessary. And looking back, if I could have seen into today, probably wouldn't have done it. Might still have to do it in the future, even on the practice trade here. But I felt necessary to roll that risk down further out of the way. Now at that point, and I'm trying not to mix up what I'm telling you with the practice trades here, but after that point, if the market would continue over the next few days to crash on down, now keep in mind I'm here at 1760, 1740. The market would crash on down close enough to where I felt like I needed to butterfly off that 1760-40 spread. And how would I do that? How would I butterfly off a 1760-40 spread? I would buy a 1760, 1735, probably 1725 is the tail. So a 1760, 1735, 1725 butterfly. And here I would do it as a 612-6 contract number of 612-6 if we were looking at this trade. But by the time that move became necessary, if the market did come down far enough to where I felt it necessary to butterfly off the 1760-40, now at that point both of my long put spreads up there at 1910, 1890, and 1865-55, that those will be so deep in the money at that point that they should be pretty darn close to not their max value of 20 points and 10 points, but that 1910, 1890 should be pretty darn close. It should be going for $17-18 at that point. So I could butterfly it off and trap that value, or I could just maybe sell it back. All right. So here we're not going to do anything with this trade considering today's action, but please keep in mind that if the market does have something like this again, just keep that in the back of your head, or roll, write it down on paper, that is a very viable move, is to simply just roll this risk on down. So what I'm watching now, well, let's do this. Here's their position. This is it right here. All right, and down $100. I know you're looking at that and you're thinking, my goodness, we haven't made any money on this thing yet. We've been in it like 2 weeks, but it hasn't been 2 weeks. Yeah, it's been about 2 weeks. So you're looking at that thinking that, but folks, this trade's in a very, very healthy place, because if we just go forward even till Monday the 25th, we'll be up, $200-300 depending on where we are. We come up in here, it's more like anywhere from 600 to 800. So, as we move forward in these days here, that this trade will start to do some good things for us. And it's a little bit nail biting, because you just don't know what each hour is going to bring. Everything's getting jerked around so much. But right now, this trade's in very, very good shape. Now my trade, because my 1800 1780s are now way down here at 60-40. I'm not worried about the downside at all. Not right now, anyway. But what I'm more concerned about is the debit I paid for that. It's showing up right here. See how above my long spread, above 1900, how we're a little bit underwater because of the debit we have in this trade? Well, same thing on mine. I'm at an even greater debit now on the upside, simply because I have an extra $1.80 cost times the number of contracts I rolled down. I have that much more cost in the trade. So I've got to watch this carefully, and if we come up to this area like 1890 again, or start to break above it, I probably need to think about trying to box this off with a call butterfly, or do something to trap that value. So I was watching this very carefully today, and as we're traveling tomorrow, I'll thank goodness our car, we just bought a new SUV just a couple of weeks ago, actually, and it has Wi-Fi in it, so it's not it's not spectacular or anything. It doesn't work real well, but it's enough. It works well enough. So while I'm traveling tomorrow, if I need to make another change to this thing, I will be keeping an eye on it, and I'll either get the service there in the car, or call the order in, or do something to maybe try to box in this this spread here, the 1910-1890, with maybe like an 1890, 1910, 35 butterfly, an 1890, 1910, 1935 call butterfly. But right now, either way, it's in good shape. But both the practice trade and the one I'm holding, so I think we're okay there. I tell you what, if we just burn a few more days, I'd love to get to the end of next week, which is if we get to the first, right? We get to the first. Look at that profit range there. See that? How nice that is. And let me blow this up so you can see it. See that? That's if we could get to the first. That's the end of next week, and have some really good stuff going on. No matter where we are, we could be in a big profit range here. So let's continue to follow this thing and see how it's doing. Now this thing right here, no action to be taken on this at all. No action to be taken on this thing right now, because it's a very sturdy position, as I've said before. And just to recap what we have here, we own a 1900, we're short at 1850, and we're long again here at 1780. At 1780. Now, in an event of a really bad crash, or we thought something really horrible was happening, we could buy an 1800 1780 put vertical spread, buying to open the 1800, selling to close the 1780, and roll that 1780 up, and that would be done at a debit, and that would show up on both sides of the graph. And I'll just show you here real quick. So if we bought an 1800 put and then sold the 1780, and we just did that at the current price, it would put us a debit of 550, and you can see that it's showing up in both sides right there, and over here. There we go. See that? So, but right now there's there's really no action to be taken on this thing. So let me take that back off. There we go. Now again on this one, what I would really like to see, and it's kind of almost contradictory, because on the previous trade we just looked at, I would be perfectly happy if the thing just kind of treaded water and went nowhere, and that would be fine for this one too. If we just treaded water and went nowhere, but this one's going to take longer to mature. You see that? Watch how slow that line moves as we go through the dates. It's going to take a lot longer to mature. But on this one, if we went up some, that would be the most comfortable thing. But but either way, I'm fine. You know, if we sit still here where we are, or if we slightly go up, we'll be okay. Especially if we go up, because we'll start to see some immediate good profit on that. Now, if we start to take another dive down, what we could do, we know that we have 20 points of risk in this butterfly, because we own a 1900. We're short two 1850s, and then we're long one at 1780. So we own 50 points against 70 points of risk. So we're short 20 points of risk. And what we could do is we could come in here and buy 10 points out of this credit side right here. And we could even do like an 1835.25. That would take 10 points of risk out. Less the debit. You know, if you pay $3 for it, it's only taking 7 points of risk out, not 10. Even though you're buying a 10-point wide spread, if you pay $3 for it, you're only taking out 7 points of risk. But I mean, 7 out of 20 points is a nice little bite out of the risk. So we could do something like that. So we don't have to just wait until the thing comes down here, you know, way down in this area and just gets washed out before we decide to roll that 1780 up. We could actually start taking a little bit of risk out of this credit side right away. Now, something else I just want to point out to you here today to get you thinking about is, you know, you're thinking, well, you know, Jonathan, the thing starts coming down really hard, and we have to start taking risk out of this butterfly. What then? Well, there's ways to make that back up, that cost. There's ways to make that up later. All right. So, you know, keep that in mind. There's other things we can do. We could eventually butterfly off the whole credit side, and I won't get into the details of how to do that. But we could butterfly off the whole credit side of that trade, and then box in the income side, which is between 1900 and 1850. We could box that in with like a call butterfly, box in those 50 points. Something else to keep in mind is, if you know, we have this thing on for a small debit of 30 cents. Do you remember that? We had that little debit of 30 cents. That's $30. So, you know, if we had 10 contracts of this, that would be a $300 cost, which is not much. But just keep in mind that if the market started rallying really hard, I mean, let's just say that, now this isn't the trade, mind you, this is just the one we talked about before. The market just started rallying straight up, and we wanted to take some of that cost out of this trade. What we could do here, and I'll show you an example of this. We could roll our long put, which is at 1900. We could just roll it down by, you know, 5 points, 10 points, and if we do it right now, it's going to be very exaggerated because that portion of the trade there is in the money. But you know, for example, if we would sell our 1900 put, okay. No, that's the one we own. That's this one right here. That's the one we own. If we would sell at 900 and roll it down and buy it at 1890, for example. So we just rolled it down 10 points. Everybody see that? We just rolled that thing down 10 points. If we did that, it takes us from a 30-cent credit to what? To a 450. I'm sorry, a 30-cent debit. We started a 30-cent debit. But making that move, rolling that put down from 1900, from where it was right here at 1900, remember that? From rolling it from 1900 just down 10 points. Now that adds 10 points of risk on, because we're giving up 10 points of our income side of the trade. So that increases the risk by 10 points. But if the market's way up here at 2,000 or 2,100 or wherever, you know, if it's way up in here somewhere, you're not so worried about the downside risk anymore. But if we would sell to close that 1900 and buy to open an 1890, that would take our cost basis from a 30-cent debit to a 450 credit. So how much is that spread going for right now? How much credit could we sell that spread, selling to close the 1900, buying to open the 1890? And that's this one right here that I'm circling. If we started out with a 30-cent debit, but doing that move would put the trade at a 450 credit, that means that that spread's going for 480, right? It's going for 480. And if you look at the math right here, 83.25 minus 78.45, you'll see that that's 480. It should be, right? So, and that's what we have here. And you can see on the upside now we have, if we finish anywhere above our long 1890, we have $450 of profit. Is how much that should be. Right, it should be exactly 450. Not spectacular again, but again, it gives us profit all the way on the entire upside without any problems. Okay, so that's something we could do. We could either roll our long spread down. Let's go back to our original trade. We could roll our long spread down from, we could roll our long put rather, roll our long put down from 1900 even to 1895. That would probably bring in 250 to do that right now. But we don't want to do it right now because the market's trading in the fly here. It's in the triangle, right? It's right in the middle of our long spread is where it's sitting. So we don't want to do that right now. But later on, if we rally really hard and get up in here, we can take some cost out of this trade by rolling at 1900 down, or we could roll the shorts of the trade. We could roll those up. Either or. But the thing is I have a choice to do either, whichever one I decide I want to do. Okay, folks, that's all I have for you here this evening. I hate to jump off so soon, but we have to get on the road, and that's all I had to share with this evening anyway. Nothing new right now. We've got plenty on our plate to deal with, so let's just keep it at that. But I appreciate y'all coming out this evening, and hopefully you're learning a lot and enjoying this. And I will catch up with you when we get back early next week. We'll see you all later. Bye bye.